welcome. Very excited to have you all. My name's Amberly Chernoff. I'm a member of the Thomsen team here at the Modern Realty Partners. We're very excited to bring you this opportunity to learn about the 1031 exchange and how to save on some taxes when investing in real estate. We're partnered here with Aaron Zieg from A+ Mortgage.
Hi, everyone. Aaron Zieg with A+ Mortgage. I might have met some of you at the last seminar we did, where we talked about real estate investing in a multitude of ways, whether it was how to identify the right property that's going to meet your goals, whether it's short-term or long-term, from a cash flow standpoint, from a wealth building standpoint, and a whole bunch of other stuff. We did touch on tax savings. What we really didn't dip into that time quite as much was the 1031 exchange. So today we're going to go narrow and deep on that. Rather than us talk about it, we are bringing in the true top of the line expert. You're going to get to meet Lauren from Exeter very shortly here. And I'm not going to delay any further. We're going to turn it over to Lauren.
Thank you.
Thank you, Lauren, for joining us and meeting us today.
Good evening, everyone. My name is Lauren Spidell, and I am with Exeter 1031 Exchange Services. I am regional manager, and I cover the Midwest, but I'm not specific to any territory. I really can work with anyone that's doing a 1031 exchange nationwide. A little bit about our company. Again, I work for Exeter 1031 Exchange Services. We are a nationwide qualified intermediary. We handle all different types of 1031 exchange structures. Sure, this is not. Let me just.
No, it didn't need to be.
It doesn't?
Nope.
Oh,
It
did it go through? It did go through. There we go. Sorry about that.
It might have been just a delay.
It was
Waking
delayed.
up.
So this first page is a QR code. If you take a picture of this QR code, it'll actually take you to my guidebook, which is our most requested marketing piece. If you ever are looking for hard copies of that marketing piece, reach out to me. Feel free to email me, call me at the end of the presentation. You'll have my contact information. But this is a changing link. So as things are changed within the code, updated, this link will continue to change as well. So it will have the most up-to-date information. A little bit about our company, as I was saying earlier, our home office is actually located in San Diego, California. That's where we've been for about 20 years. We also have a trust company located in Cheyenne, Wyoming. That will provide some additional safeguards for our clients, which I'll talk about in just a few minutes. But we are a nationwide company, so we do all different types of 1031 exchange structures. In this presentation, we're mostly going to be focusing on forward exchanges, but we will briefly touch on the other structures that are available, which are reverse, improvement. We even do foreign property exchanges as well.
I wasn't sharing before. No, sorry.
I don't know if
That's because I had to go back to the screen. There you go.
Okay. So first, we'll start off with what is a 1031 exchange. You, of course, want to have a basic understanding of what it is, why you would do one. And 1031 exchanges have really been around for over 100 years. It became a code in 1921. At that time, IRS issued Section 1031, and it allows you to take investment property that you have held for investment purposes, so rental income, appreciation, or use in a trade or a business, sell that asset, defer the tax liability associated with the sale, and have more of your equity or your money working for you in another investment property, again, used for rental income, appreciation, or for something used in a trade or a business. For the most part, 1031 exchanges really remained unchanged until the 1980s. So in 1921 and beyond, people would do like-kind exchanges sitting at the same closing table. So they would sell and buy literally within minutes of each other. And then the code changed due to TJ Starker. So some people may know 1031 exchanges as Starker exchanges. And that is because TJ Starker was a timberland owner in the Pacific Northwest. And he sold his property to a paper mill company. They gave him units instead of cash. And then as he found properties that he liked, Crown Zellerbach would actually present them to him and he would trade in his units. So over a 5-year period, he traded in all his units. He filed his exchange. He was audited by the IRS. The IRS said, you're not following the regulations. He paid the tax, but took the IRS to court for 4 years and eventually won. And so that's what changed 1031s, so that you were not necessarily sitting at the closing table doing a sale and the purchase on the same day. They said you have a total of 180 calendar days to do an exchange. One of the biggest reasons of why you would do a 1031 is the income or the tax liability of the sale. When you have a primary residence, you usually have section 121, which is also called the primary residence exclusion or the homestead exemption. If you are a single individual that has lived in that property 24 out of the past 6 months, 24 out of the past 60 months, you qualify to be able to exclude $250,000 of cash. If you are married, it would be $500,000 of gain that you can exclude from your income. So huge benefit for owning a primary residence, but you don't get that same benefit with an investment property. So with a 1031, you are deferring all of that gain. So you're deferring the depreciation recapture, you're deferring the capital gains tax, the state tax. So you have more money working for you in another property. So this is just an example of how you really calculate tax liability. A lot of clients will call and they'll say, I bought a property for $350. I'm selling it for $450. I only have $100,000 of gain. And that's not really how tax liability works. It's a little bit more complicated than that. So let's go through this together. Normally, the purchase of your property is your cost basis. Your original purchase price is your cost basis. And cost basis is important because it comes into play, but cost basis does not remain at the same number. It does fluctuate. So when I'm talking to someone about a 1031 exchange, oftentimes I'll ask them, okay, you bought it for $350, but what is your current adjusted cost basis? Many times people don't know. So my best recommendation would be to make sure that you talk to your tax advisor or CPA. This clearly is a tax code. So you want to involve them in this decision-making process, and you want to find out, what is my adjusted cost basis? Basically, adjusted cost basis is the original purchase price minus the depreciation plus capital improvements that you've made. And then you're going to compare that with your net sales price. Your net sales price is the gross sales price minus routine closing costs. That's what's equaling your total gain. Now, with your gain, not everything is taxed at the same rate. So a lot of times people will call and say, okay, so if my gain's 100 grand, my tax liability is going to be 20%. That is just the long-term capital gains. So let's walk through an example of why you would do a 1031 exchange. Let's say your original purchase price on the property was $250, and then you owned it for many years. And let's say you have depreciated the property down to land value. So land cannot depreciate. Let's just say that your tax advisor has assessed that the land value of the property is $50,000. So you've really depreciated it by $200,000. Normal investment property, you can, with standard line depreciation, is 27.5 years. So for 27.5 years, you get a certain amount of a write-off on your taxes for owning this property, which is great. Except when you sell that property, you're going to owe some of that back. And so when you're doing an exchange, you're deferring that. So in this example, let's say that you decide to sell it, sales price is $530. After your permissible selling expenses or routine expenses, that would be broker's commission, title insurance, closing agent fees, notary fees, wire fees, qualified intermediary fees. Your price.
I mean,
Sure. Okay. So your net sales price is 500,000. So let's say
Oops.
Remote again.
Try it again.
Okay, so what we're doing here is we're comparing the net sales price of 500,000 versus the 50,000. That ultimately is going to be your total gain. So your total gain is 450,000. If you're not doing a 1031 exchange, you're going to have tax liability on 450,000. Now with that, the first thing that's often taxed, so this is that bucket that I mentioned, is depreciation recapture. So they're going to take a look and say, okay, how much depreciation did you take over the lifetime of owning this property? In this scenario, they took 200,000. So you would owe 25% of that back to the IRS. That's about 50 grand going back to the IRS. Then you've got capital gains tax. Let's just assume you're at the 20% bracket. So once the depreciation is kind of paid for, that's kind of off the radar. You're now looking at the capital gains tax. So 20% of 250 is another 50 grand. Now the Wisconsin state tax is 7.65. So that's a little over 19 grand. And then if your income's high enough, you might be hit with the AMT tax at 3.8%. I'm not calculating that into this number, but in a regular sale off of this sale of investment property, you're going to owe almost $120,000 in taxes. So you would only have about 380,000 to reinvest. With a 1031, you're deferring all of those taxes and you have 500,000 to reinvest. So it's a great way to build your wealth through real estate investing. Instead of paying that tax, you are deferring it. I'm mentioning deferral because it's really important to know that your tax liability isn't necessarily going away. It's being deferred. So a lot of people will use the exchange to build their portfolio. They go from a single family home to a duplex, to a fourplex, to an eightplex. Some people start to downsize. They have, multiple units and they want to buy one larger single family unit that they rent out. So any of that kind of structure could work. Now, as I mentioned, this is tax deferred, not tax free. The goal is really to exchange throughout your life so that eventually, if you've built your wealth through real estate investing and you pass away, your heirs are going to receive a step up in basis. So now let's say you've reinvested that 500,000, it's been 15 years, and now your portfolio is worth $1 million. You die, your beneficiaries inherit that asset. Their basis is now $1 million. And if they sell it for $1 million, they have no tax liability. So it's a huge generational wealth builder. That's the term we all hear these days, generational wealth, generational wealth. This is a great way to build it. Some people will also say, yeah, but eventually I have to pay that tax. Yes, if you aren't in a situation where you hold on to those assets and continually do exchanges, yes, you might be in a situation where you are going to be paying some tax. Some people do that on purpose. You might be retired in a lower tax bracket now. You might purposely choose to start trading down in value so that you choose how much tax you're paying. That's what we call partial exchange. So let's say instead of reinvesting 500,000, you reinvest 450. You have a difference there of 50,000 that you decide, I'm going to take that and I'm going to pay tax on it. But again, based on income numbers, your rates might be lower. With that, it's always good to talk to an estate planning attorney. Make sure your assets are held in a way that when you do pass, the transition is easy for your heirs. If you can avoid probate, if you don't have to deal with estate issues, having an estate planning attorney on your side to make sure everything's nice and neat is always some good advice. Now, in order to successfully complete an exchange, there are certain requirements. Just to get started, there are a number of terms you're going to hear throughout the presentation. The relinquished property is the property that you're selling. The replacement property is the property you're purchasing. So you could have multiple relinquished properties and you could have multiple replacement properties. You have to have at least properties, of course. Prior to 2017, you could do exchanges with personal property. You can no longer do exchanges with personal property. So sometimes we have people say, I'm selling a business. Can I do an exchange? No, the 2017 Tax Act actually changed personal property exchanges where they are no longer allowable. So this is just real estate. Now, my first step that's not on this page, but is equally important, is to talk to your tax advisor when you're selling investment property. That's kind of step one. You want to figure out how much tax liability you might have. If you have losses that could offset the gain, maybe an exchange may not make sense, or maybe your tax liability is not that great. And in that situation, this may not work well for you. But your next step is to contact a qualified intermediary, and that's what we are. So we help advise, we help structure. We must be assigned into the sale and the purchase before closing. So before you actually have your closing, we need to be assigned into that transaction. You can sign contracts, that doesn't start any deadlines, it's closing dates, the actual closings that matter. So we're going to draft the necessary exchange documents. We are going to safely hold the proceeds. And again, we try to be more advisory than other qualified intermediaries. So we do help advise and help structure. We cannot provide tax or legal advice. So there is definitely a line there. If we are providing tax or legal advice, we actually disqualify ourselves from being a qualified intermediary. We have to be an independent third party. All we're doing is handling the 1031. So no conflict of interest there. We will, again, walk through all the requirements with the clients. If we see something that might cause risk, now it's a risk decision that's based on the client. So we'd say, this is where we might see risk if you're audited. This is something that you want to discuss with your tax advisor or your attorney. Everyone's risk tolerance is a little bit different. Hopefully there's no risk and it's a very vanilla transaction, because those are the easiest. Now, as I mentioned earlier, in order to qualify, it's got to be investment property. So rental income, appreciation, or use in a trade or a business. Property held for sale typically will not qualify. So unfortunately, your fix and flippers aren't going to qualify for an exchange because you don't have the intent to hold. You have the intent to sell. Same thing with condo conversions or property acquired to develop. Developers usually don't qualify because they're building something to sell it. So you really have got to have the intent to hold these properties, the relinquished and the replacement. Sometimes I have people call and they say, well, I've held the property for 12 months, so I qualify. And in the code, it actually doesn't give you a timeline. It just says that you must be able to prove that you had the intent to hold. So there are no specific timelines, though most exchange experts will recommend holding a property for somewhere between 12 to 24 months. Because if it is an income producing property, that income is going to show up on 2 or 3 tax returns. So if you were audited, you could easily show that it was investment, because that's how it was reported. Not everyone fits into this. I had a client call saying I wanted to buy a property to buy it at a low value and then fix it up and rent it out. And every time I did something else would go wrong. And I have just dwindled my savings and I'm ready for a turnkey property. So I want to sell as is. He decided to do the exchange because he had documentation to prove all of this. The type of loan you get, the emails maybe between your realtor, documentation to prove that things just kept going wrong, invoices. So he felt comfortable, and so did his tax advisor, with moving forward with an exchange. So length of time does not determine whether a property qualifies. It's intent. With that, we also get questions about like kind. You'll hear 1031 exchanges be called like kind exchanges. So a lot of times people think, I'm selling a condo, I have to buy a condo, or I'm selling a commercial space, I need to buy a commercial space. And that's just not accurate. Any type of real property qualifies as long as you have the intent to hold it for investment purposes. So our next slide here is going to give you examples of like kind properties. The first 6 are well known: single family, multifamily, office, retail, industrial, vacant land, all of that qualifies. Lesser known and transactions that we do less of would be oil and gas interests, mineral interests, air and water rights. And then there's also some fractional ownership opportunities for people. If you've got someone who maybe wants to be done with renting, they don't want to deal with tenants anymore. And we kind of call it the 3 T's: tenants, trash, toilets. They could keep going on and on with the T's, taxes. They could sell and go into something that's like a portfolio. So usually a nationwide real estate company goes out, they buy a portfolio, they wrap it either under a syndicated TIC, which is a tenant in common structure, or a Delaware statutory trust structure. And you're basically buying a percentage interest of that portfolio. So the IRS did rule, I think it was back in 2005, that does qualify for like-kind treatment. So, income that they get, losses that might happen, expenses are going to be based off of their fractional ownership of that portfolio. And it might be a very small percentage. I think the smallest I've seen has been about 25,000 into one of these portfolios, but this is a security. So you would buy it from a financial advisor that does alternative investments. Yes,
Would a real estate investment trust, would that be along that line?
great question. That will actually be my next slide, but no, they don't qualify. And that is because with real estate investment trusts, you purchase shares. You don't actually own the underlying real property.
Got it.
So that would be the difference. And so here's my thumbs down, which is where you'll see the REITs as well. So personal use assets. So your primary residence typically won't qualify. I say typically because let's say you do have a portion of your property that you rent. That portion could qualify for an exchange. Second homes, vacation homes usually don't qualify. They can though with proper planning. That'll be my next slide. And then property held for sale. We've already discussed that. If you don't have the intent to hold it, it's not going to qualify for an exchange. Securities, so cash, stocks, bonds, mutual funds, and REITs, they are not real estate, so they will not qualify. Interest in equity, so partnership membership interest, LLC interest, shares in a corporation, those can do exchanges, those entities can do exchanges, but you can't sell real estate and buy membership interest in a corporation or buy membership interest in an LLC. You're buying personal property, not real estate. Now, vacation property, second homes, they can be a great avenue for some people, but it does take proper planning to qualify for an exchange. Oftentimes when someone owns vacation property or second homes, they're not prepared to do an exchange. They just know that they don't consider the property their primary residence. They consider it investment property for them. But in order to qualify for the last 2 years, so on the sales side, you must have held it for investment the last 24 months. You must rent the property for at least 14 days each year, the last 2 years, and limit your personal use to 14 days or 10% of days rented, whichever is greater. So if you rent it out for 300 days, you could use it for 30. If you're staying there to make repairs, to clean it, to paint it, to get it ready for the next renter, that doesn't qualify against your personal use. I would just hold on to any receipts, documentation. I get the question all the time, how will the IRS know? I don't know. I have not gone through an audit myself, knock on wood. And I do not own vacation property or second homes. So the reason why it triggers that vacation property or second home status is because there's personal use. So if you've got just a property on the beach that you rent out and you don't use it all, it's not gonna fall into this bucket. With that, the purchase also, you'll want to make sure that you're following those safe harbor guidelines. And safe harbor guidelines, just to kind of explain that, it's like a box. If you fit nicely into this box and you're audited, you're not going to have any issues. But if you don't fit nicely into that box and you're just kind of shoving yourself in there, we don't really know under audit how it would be viewed. So your guess would be as good as ours. We don't have anything to go off of to point you to. And a lot of times people will say, well, I use it all summer long or I use it all winter long. That's where we've got usually an issue. Now, the reinvestment requirement, I would say, is probably the most misunderstood requirement of the exchange. A lot of times people think I only need to reinvest my gain. I only need to reinvest my equity. I don't need to reinvest the debt because the debt's being paid off. All of those are false. You need to reinvest everything to have a fully tax deferred exchange and trade equal or up in value based on that net sales price. So you want to make sure that if you're selling a property, you're basically buying higher, equal to or higher than what you sold. So let's just use that same example from before. You sell a property for $530, your net sales price is $500, really easy numbers. You have a mortgage on that property of $250. That mortgage is secured to the property. That mortgage has to be paid off. So $250 of cash is going to come to us, the qualified intermediary. We get questions all the time. I just closed yesterday and I want to do an exchange. They haven't released the funds to me. You've missed the opportunity to do the exchange. We need to be assigned into that sale prior to closing. The settlement statement needs to show that a qualified intermediary is involved. So at closing, the proceeds would come to us, and your goal is to buy for 500,000 or higher. As I mentioned earlier, you could always do a partial exchange. So you could choose to trade down. You could pull cash out. Unfortunately, this is what, where I definitely can feel the anger from taxpayers when they find out that, let's say, the 50 grand they use as a down payment, now if they want that back, it's not going to be viewed as their equity. It's going to be viewed as gain. Basically, the IRS wants their tax. So any amount not reinvested is going to be considered gain before equity. So all of your gain would need to be taxed before you can grab that equity amount and not pay tax on it. So that's really important because a lot of people think that they can just pull out that equity, not have any tax liability, but it is the idea of your first dollar in is your last dollar out, that investment theory. So think about it even for your own IRA or 401k, they're going to tax the gain before they tax the money that you put in. That actually would not be taxed. So we discussed net sales price. This is just a list of permissible expenses. Some of the big ones that we see would be real estate brokers' commissions, qualified intermediary fees, closing agent fees, CPA or attorney fees. Those are all permissible. Non-permissible expenses. So if you use your proceeds to pay for financing or lender costs, loan fees, loan points, prorated property taxes, that's a big one, prorated rents, insurance premium payments, security deposits. Sometimes people want to be paid back for the money they put in to list the property, making some repairs. That would be non-permissible. So if you use your proceeds to pay for those expenses, you'll be taxed on those amounts. If you did get the QR code in the beginning of the presentation, I believe that is on page 19 or 20 of the booklet. But I talk to my clients and tell them, if you want me to review your estimated settlement statement before closing, I'd be happy to do that with you. That way you kind of have an idea of what you might be paying in taxes if you do use your proceeds to pay any non-routine closing costs. With that being said, you could bring out-of-pocket funds to closing to cover those expenses if you wanted no tax liability. Most people just have them pull from the proceeds, but it is a personal preference. Now we're getting a little bit into the weeds here. So this may or may not be something that you retain, because I already know I just gave you a bunch of information on the exchange. But this is something that we are going to discuss as the qualified intermediary. We're going to ask the client, how do you own this property? You'd be surprised by how many people don't know how they own their property, but ultimately it's who's paying taxes on this property, not necessarily property taxes, but the income, who's paying the income, where's that income being reported? So if I own a property in my name, I want to make sure that when I purchase the replacement property, that I am the taxpayer on that purchase. If you're in a community property state versus non-community property state, that comes into play if you want to add spouses or remove spouses. Let's say I want to buy in my single member LLC or my fully revocable grantor trust. That's usually a disregarded entity for tax purposes, meaning it's one and the same with me. So if I do have a client that owns a property in their name and they want to buy in their trust, we just need to confirm that it is disregarded for tax purposes. If it's a regarded entity, that would cause an issue. There's actually no way to really report the exchange if you have a regarded entity, because a regarded entity is a separate taxpayer. So it would have its own tax return. Now, the exchange period, it probably gives everyone the most heartburn. You do not have, like I mentioned, 5 years to complete an exchange. You have a total of 180 calendar days. The day after closing begins day one, and you have 45 days to identify possible replacement properties. We give you a form that you would use called your identification form, and you would need to list the properties you're interested in purchasing. You have up until midnight on the 45th day to change that form. After the 45th day, you can no longer amend your form. So you will need to purchase something you listed, or you're gonna have a failed exchange, which is a regular taxable sale. So there's no penalty for attempting an exchange. And then after the 45 days, you have another 135 to close. So keep in mind, it is not 45 plus 180. It's a total of 180. These are calendar days. So you're gonna include Christmas and New Year's, and you're gonna include your birthday, and you're gonna include the 4th of July. Those are all being counted as days. It does begin at the close of the sale, if you're doing a forward exchange. There's really no extensions for personal individuals. I say that because right now, there are a lot of extensions that are out there due to natural disasters. So we had clients that had property in Florida when the hurricanes hit. There were additional extensions granted. So it's always good to check with your qualified intermediary. You can check the IRS website. Ultimately, it will be up to your CPA to determine if you qualify for those extensions. And then if you close at the end of the year, so right about now, let's say, if you want the full 180 calendar days to complete your exchange, keep in mind you're going to go past the tax filing deadline of April 15th. So this may mean that you need to file an extension and then buy your property and then file your taxes. If your sale takes place in 24, you have to report it on your 24 return. Another thing to keep in mind is that if you do close right now, you're straddling 2 tax years. And so sometimes people will go into an exchange thinking, I'm going to find a property, but for whatever reason, they don't identify by the 45th day. We have to hold the funds at least through the 45 days. But during the 45 days, we can send funds out for earnest money deposit. We can send funds out for purchase. We just can't send funds back to the exchanger because we have to give them the full 45 days to identify. If they don't identify in the 46th day, we can release the funds to them. Let's say they close today and the 45th day is sometime in January. That means that that gain would be reported on in 25 return. The sale, though, still takes place in 24. Your depreciation recapture would be due in 24. But for some people, you can take a look at kind of tax straddling and see if it would make sense to report that gain in 24 or 25. So because you're straddling 2 tax years, because you could not have receipt of those funds until 25, it's going to be reported in 25, or you can choose to report it in 24. So that's a discussion you want to have with your CPA. Unfortunately, you can't just identify, 1,000 properties. You have to be pretty specific. Most people are choosing the 3 property rule to identify that lists 3 or less possible replacements. Your goal is to close on at least one of them, at least making sure that you're reinvesting enough. If you want to identify more than 3, you could, but you're going to be looking at a different identification method. The second method is called the 200% of gross sales price. Sell for $1 million, you can identify $2 million worth of real property. So however many properties you want, you do need to give estimated fair market values, and the aggregate total cannot exceed $2 million. And then the last option is the 95% exception. So it allows you to identify as many properties as you want, but you've got to close on 95% of what you've listed. So that is taking into consideration values. So if you list $1 million, be prepared to close on $950,000 worth of real estate. So make sure that if you're using that one, for example, that you either have purchased everything within your 45 days already, or you're buying a portfolio and you know that you're purchasing everything within that portfolio. You do need to be as clear as possible. So if you want to buy a unit in a complex, let's say it's a 200 unit complex, you can't just list the complex. You have to list unit numbers. Otherwise, the IRS thinks you're buying the whole complex. So you do need to be as specific as possible. My best recommendation would be to use the time period prior to the closing of your relinquished property to your benefit. If you have a 30-day escrow, go out there and start making offers. Narrow down what you want to purchase, where you want to purchase. Ideally, it would be great if you could sell and within days or a few weeks, you're making your purchase or you're scheduling your closing so that you're not butting up against these deadlines. Now, what I just described was the forward exchange. There's a simultaneous versus delayed exchange. Simultaneous, everything happens on the same day. We also call that a concurrent exchange. A delayed exchange is where you're using your time period. You're using more than one day to make that purchase. So you're going to sell first, you're going to buy second. There are also other structures that could benefit people. A lot of people who are concerned about timelines. You know, I like this property. I want to purchase it now, but I've got a tenant in my current property and I can't sell it yet. I got to wait till that lease is up. The reverse exchange can make sense. You buy first and you sell second. Now, keep in mind, it's not as simple as that. I don't want to have clients call saying, I already purchased my replacement property and now I'm going to sell my relinquished property. You cannot own both properties at the same time. So normally what happens is there's a parking arrangement. We create an LLC. The LLC acts as an exchange accommodation title holder. Most popular structure for the reverse is where we would purchase the replacement on your behalf, hold that property, park title to it. There's an absolute net lease in place, so you can get a renter in there. You can start renting it. You just cannot depreciate it while we're holding title because you're depreciating your relinquished property. And then you have basically 180 days, calendar days to sell that property. And then you become the owner of the LLC. Most people dissolve it. There's really no purpose to keep it. And the exchange is complete. There's more to it than that. If you have a specific scenario, we could always discuss it. I don't want this to be a 3-hour long presentation because you guys will fall asleep. But there's also improvement or build to suit exchanges, very similar to the reverse in that there's a parking arrangement. So sale takes place, proceeds come to us. We purchase the replacement property on their behalf, but they're named construction manager. And as improvements are made, you know, invoices come in, we sign off, we disperse funds, maybe through the exchange funds that we're holding, maybe through a lender. But their goal is to build and spend and construct as much of their exchange proceeds as possible. So if on your 179th day, you needed 10 grand of flooring, it's not like you could go buy it, plop it on the garage floor and consider real estate. It's still personal property. So we usually recommend getting pictures and videos taken of that the last time, you know, the last day of your exchange or when you're done with your improvements to really verify what's been constructed at that time. And then we also do foreign property exchanges. It does not come up very much, but foreign property is like kind to other foreign property. So you cannot sell in the US and buy in Mexico. If you're selling in Mexico, you could buy in another foreign country, but you cannot buy domestically. The US is going to consist, of course, of the 50 states. It will consist of the Northern Mariana Islands, Guam, and the US Virgin Islands. Yes. Surprisingly, Puerto Rico is not considered part of this. So now we're really getting into the weeds. So hopefully you guys are hanging on. And this is definitely something that I can review with any of you again, if it pertains to you or you want to just kind of talk about strategy for the future. But let's say that you do have a rental property. You bought a rental property in an exchange. Let's say it's in Florida. I hate to use that now because so many people don't want to be in Florida. And insurance is outrageous. But anyways, I digress. With that, you had a rental property in Florida, you've been renting it out, you decide now, I'm going to retire and I'm going to go move into it. You can do that. The longer you live there, the better. Keep in mind that your tax doesn't just go away. So if it was a prior exchange, in order to qualify for Section 121, which we mentioned earlier, you have to own that property for at least 5 years. It of course needs to satisfy the exchange on the first portion of it. And then when you do sell it, your tax or your gain is prorated based on the number of years the property was a rental versus a primary. So let's say, for example, you rented it out for 3 years and then you lived in it for 3 years and you decided to sell. Your gain's 200 grand. 100 of that is going to fall into investment use. Another 100 is going to be excluded because it's part of the primary residence exclusion. So the longer you live there, the better, the more of that exclusion you'll qualify for. If you ride off into the sunset in that property, your heirs will receive a step up in basis. So, you know, ideally that would be the best option for your heirs. With that being said, there's really no way to get out of depreciation recapture. So here we're just talking about pure gain. Depreciation recapture will still be due if you sell the property. So it just follows you. unless you pass away or you have losses to offset it. The other strategic tax planning option with exchanges would be, let's say you do have a primary residence and your gain is significant. Let's say it exceeds that 250 or that 500,000. You could move out of it, get a renter in there for 2 years so that you've proven that you've changed the intent of the asset. Sell it within that 5th year so you still qualify for the primary residence exclusion. Take your exclusion and put the rest into an exchange. Doesn't happen much in the Midwest, honestly, but we did have clients in California who bought a beachfront property for $300,000 over 30 years ago. They went to go sell it. They expected to sell it for around 8 million. They moved out. They got renters in there for 2 years. They took the 500,000 exclusion, and then they took 7.5 million and bought investment property on the East Coast where most of their family had moved to. So there's definitely ways to utilize the exchange in more than just your traditional buy, hold, sell, buy, hold, sell. This is probably my favorite topic. Our industry is completely unregulated, so anyone can be a qualified intermediary. So when you go online and look for a qualified intermediary, which many people do, a lot of times people are just looking for, what's your fee? How much do you charge? There's a lot more to it than that. There's a company, for example, I believe it's on the East Coast, where they charge a very low flat fee. They're probably not going to provide the safeguards. They're probably not going to provide the advisory services that other QIs might provide. There was a very large title company called Land America. They ended up having an arm of their business that acted as a QI. Their kind of logo was, we're too big to fail. Well, they took exchange funds and put it into the stock market in 2008. We all know in 2008, the market crashed. They lost client exchange funds. They started moving funds throughout their organization and eventually filed for bankruptcy. The bankruptcy judge ruled that since the funds were commingled, they were not segregated, they were not held in a qualified trust or qualified escrow account, that everyone was creditors. So it took about 10 years for those clients to get their funds back. With that being said, they're also, I'm not sure if anyone ever watches American Greed. It's a show on MSNBC. There was one about a QI. His name was Ed Oken, and he was acquiring QIs in Florida. And eventually the last QI that he acquired basically blew the whistle on him. He was using client exchange funds to buy expensive properties, to buy boats, cars. He bought his wife a hair salon, so she never had to wait for a hair appointment. And he is now spending 100 years in federal prison and spent $100 million of client exchange funds. I just recently talked to a realtor out of the Washington, D.C. area. She always referred clients to an attorney that she used. The attorney was using the money to send his daughter through college. So it's really important to find out, how are you holding my funds? We have been in business for over 20 years. We also have errors and omissions insurance, fidelity bond, general liability, each at $5 million, 2 million cyber fraud, 2 million wire fraud. We can provide insurance binders, but we also decided to become regulated. So we are a trust company. We offer other products like self-directed IRAs, self-directed 401ks, land trusts, specialty escrow holding accounts. We are regulated by the Wyoming Division of Banking. So that's where our trust company is located. That allows us to set up a qualified trust account for every client. So your funds are legally protected. They're dual signature accounts. If something were to happen to us, your funds are earmarked and protected as your exchange funds. I don't expect anything to happen, but it's always good to have those safeguards. And we can provide up to $150 million of FDIC insurance. So we can handle very large transactions. A lot of QIs will say we have, $100 million insurance bond. Look at all of the companies that cover that bond. Ours is just our exchange company. So that is definitely important. And then a lot of them will also say, we're audited, but they're internally audited. We have a government entity actually auditing us. And with that, just a brief recap. Again, we're Exeter 1031 Exchange Services. We're a qualified intermediary. Not all QIs, qualified intermediaries, can act as an exchange accommodation title holder. So we are able to do some of those more complex transactions like the reverse, the improvement exchange. We also can do exchanges in all 50 states. We are available 24/7. We have an 800 line. There's about 8 of us whose phones all ring at the same time. So if you are on your 45th day and it's Christmas and you want to make sure that, you know, you're amending your form on Christmas and someone is going to see it and make sure it's okay, you can call our 800 number. And then also our website is a great resource. It has a lot of information on there. And then this is my direct contact information, should you have any questions. And there's that QR code again. But before we go, I just wanted to check to see if there are any questions online, any questions here, just to address any of them before we wrap it up. If you do have any questions, I'll give you guys just a couple of minutes. Someone raise their hand to put it in there.
Where's
Amelia raised hand under participants.
Hi, yes, can you hear me okay?
oh, yep, I can hear you because I have an earbud in, but I can transfer your question if you want.
Sure. I just wanted to confirm that I heard you can also do international property. You can work with international purchases or exchanges as well.
Yeah, she just wanted to confirm that you can do the international purchase exchanges as well. Foreign.
You could do foreign property exchanges, but you would have to be selling foreign property and buying foreign property. We would probably want to have a discussion on where it's located to see if there's any issues. Like, for example, China does not do 1031s because they have to release the proceeds to the owner that's on title. So we cannot be assigned into the transaction. So it just depends on location, but yes, we can do those.
Okay, great. Thanks.
Thanks.
Yep. Okay.
Can you go back to the fractional shares and talk a little bit
The
more
DST and the
about-
tick?
Yeah,
Okay.
so like, let's say you were part of, you were maybe an LP in like a syndication. Can you pull out of that and 1031 those into another syndication project?
Usually no. And I
Okay.
say usually no, because sometimes there are syndicators that will set up the structure in a way that kind of carves out a piece for exchange investors. Normally with a syndication, it is an LP. So it's a limited partnership. And so you're just a partner, or you own units. And they have the general partner basically managing everything. And they like having that control. When you carve out a piece for a tenant in common, so that's how you would have to hold title with the syndication or the general partnership owning, let's say 75%. And then they have 25% for exchange investors. That would mean that you would actually own a percentage of real property. So you most likely will have voting rights. You're going to show up on title. The loan that maybe they used, you would be underwritten for. So usually syndicators don't like that because they want to be able to make those decisions for all of the investors. They don't want to have to get votes. That can kind of throw off what they eventually want to do with that portfolio. So it just depends on each syndication, each portfolio that they create. They can, it's just whether they want to do it or not. But usually when you are a member of that syndication, you are like, you own units, you own personal property. So you can sell your units, but it wouldn't qualify for a 1031 because it's not real estate. Any other questions? Okay. Well, I will wrap it up. And if you guys have any questions, my contact information is here. If by any chance you would like hard copies of that brochure, or you can go to our website, my contact information is there. I'd be happy to chat with any of you. Thank you.
Thank you.
Thank you.